What if I told you that the single most powerful force shaping civilization wasn't the sword, the wheel, or even money itself, but interest, the price of borrowing the future? Imagine owning something that doesn't physically exist. Not gold, not grain, not land, but time. A promise to give back more than you received, even when that more hasn't been created yet. This is the invention that built empires and destroyed them. It fueled revolutions, wars, and the digital economy in your pocket. And yet almost no one can say when or why it began. Before there was money, there was trust. Before markets, there were promises. And before loans, there was the first time one human said to another, "I'll give it back later." That simple idea to delay repayment was the seed of civilization. But when humanity added one extra word, interest, everything changed. It turned favors into contracts, trust into obligation, and cooperation into control. Today, debt shapes everything, from how governments run economies to how you buy your morning coffee on credit. Global debt now exceeds $310 trillion, more than 3 times the world's entire GDP. And this entire system is built on an idea that started in a village 5,000 years ago as a solution to a farming problem. Let's go back to ancient Mesopotamia, around 3000 BCE. The city of Uruk hums with trade. Barley is currency, clay tablets are receipts, and temples are banks. Farmers borrow grain from the temple before the harvest, promising to repay once the crops come in. Simple enough. But then the priests realize something. Lending out grain has a cost. It spoils, rats eat it, and time makes it less valuable. So they start demanding a small extra portion in return, a premium. And that, historians believe, is the birth of interest. On those ancient clay tablets, you can still read the world's first interest rates. 33% on grain, 20% on silver. To the Sumerians, this wasn't greed, it was natural. Everything in their world reproduced. Fields grew more crops, livestock multiplied. So they thought money should too. But there was a dark side. When drought hit or harvests failed, debt snowballed. Peasants sold themselves into slavery to pay their loans. Entire families became collateral. So every few decades, a new king would rise and declare a clean slate, a debt jubilee, all debts cancelled, slaves freed, ledgers wiped clean. This wasn't out of mercy, but necessity. Because when too many citizens were trapped in debt, the kingdom itself began to rot. Sound familiar? As civilization expanded, so did the logic of debt. The Babylonians perfected it with complex legal codes, like Hammurabi's, which regulated interest. The Greeks moralized it. For them, charging interest usury was unnatural. Aristotle called it money breeding money, a sin against nature. But the Romans industrialized it. They turned lending into big business and interest into statecraft. Roman soldiers, paid in coin, would spend money in conquered territories, and then the empire would collect taxes in that same coin. To get the coins, locals had to borrow from Roman moneylenders. Debt wasn't just personal, it was imperial policy. And yet Rome's downfall also came through debt. As inequality soared, small farmers lost their land to creditors, the poor revolted, and the republic collapsed into dictatorship. Every great empire, it seemed, discovered the same law. Debt builds nations and then breaks them. After Rome fell, the idea of interest became taboo again. The Catholic Church banned usury. Money could be lent, but not to make more money. For nearly 1,000 years, Christian Europe existed under a moral economy where time itself could not be sold. But elsewhere, a revolution was brewing. While Europe banned interest, the Islamic world innovated. Scholars viewed exploitative interest as sinful, but they created profit-sharing models and trade finance centuries ahead of their time. Merchants across Baghdad and Cairo used paper drafts, the ancestor of the modern check, financing vast trade routes without ever touching a coin. Meanwhile, in Christian Europe, Jewish lenders filled a moral gap. Forbidden from owning land, many turned to finance, lending to kings who needed gold for wars. And when debts grew unbearable, Kings would expel their creditors, seize their assets, and blame usury. England, France, Spain, all repeated the cycle. Debt had become both a tool and a scapegoat. Then came the Renaissance and, with it, double-entry bookkeeping. Venetian merchants realized they could track both assets and liabilities, and the invisible became visible. This changed everything. Now the future could be measured, time could be priced, and interest became civilization's heartbeat once again. In 1609, the Amsterdam Exchange Bank standardized lending, creating the first modern central bank. Then the Dutch created government bonds, allowing states to borrow from their citizens with promises of interest. Suddenly, war became affordable, if you could finance it. Empires rose not by conquest alone, but by credit. Britain perfected this model. To fight Napoleon, it issued so much debt it would terrify modern economists, yet it worked. Britain's financial credibility was its greatest weapon. By the 1800s, banks didn't just lend money, they created it. Every loan expanded the money supply. Debt became the invisible architecture of progress, fueling the Industrial Revolution and colonial expansion. But interest is a double-edged sword. It assumes perpetual growth, that the future will always be bigger than the present, and when it's not, systems crash. The Great Depression wasn't just a stock bubble, it was the collapse of credit. After World War II, the Bretton Woods system tried to stabilize the world by tying currencies to the US dollar and the dollar to gold. But by 1971, Nixon ended that link. Money became purely symbolic, backed by nothing but faith and debt. From that moment, the global economy entered what some call the age of synthetic growth. We weren't creating more, we were borrowing more. And interest, now controlled by central banks, became the lever that steers entire nations. In 2008, the financial system imploded. Debt instruments built on debt collapsed. Governments printed money, cut rates to zero, and saved the banks. But the cure became the addiction. A decade later, borrowing felt free again. And then came 2020. The debt graph went vertical. By 2024, total global debt hit $315 trillion. The system still runs, but only because interest rates are carefully engineered illusions. Push them too high, economies seize up. Keep them too low, inflation devours savings. Either way, the bill always comes due. The same logic that enslaved farmers in Mesopotamia now governs nations. In the US, the government pays over $1 trillion a year in interest alone, more than the entire defense budget. And on an individual level, we're trained to think of credit scores as moral worth. Debt has become identity. History, it turns out, is cyclical. Debt grows faster than production, then it implodes, and then we reset. From Babylon's debt jubilees to modern quantitative easing, we keep rediscovering the same paradox. We can't live without credit, but we can't survive its consequences forever. Every financial system is a story about power. Those who set the rates control the world. The invention of interest is both genius and curse. It unlocked civilization's growth, but made collapse inevitable when growth stops. Right now, we are living in an experiment no civilization has ever survived. Permanent debt with no reset button. If you found this story eye-opening, don't let it vanish. Share it, because understanding how interest began is the first step to understanding how our world really works. And next time you hear the words interest rate, remember, it's not just a number. It's a 5,000-year-old spell that still binds us all. Subscribe if you want more deep dives into the hidden mechanics of civilization. Thanks for watching.